Hi all, I'm Matthew. I'm a CFO with the CFO Centre, specialising in luxury hospitality, the world of wine, the world of beverages.
Hi, I'm Kishore Hasiani. I've been with the CFO Centre for about a year and a half, specialising in mining, infrastructure and real estate.
Hi, I'm Susan Robson. Don't adjust your sound. I am a Geordie. I am from Newcastle. My specialist sectors are tech, healthcare and retail.
Okay, my name's Mike Omani. I've been in the CFO Centre for 3 years now. It's flashed by, but of course it was right in the middle of COVID. My core hospitality, hotels, restaurants, food and beverage is my sector. And that's what I kind of get up out of bed every day.
Thank you all for joining us and discussing the 2023 April budget. I don't think there was any particular surprises for you all.
No, quite boring. If I'm honest, there wasn't much on there. So
This budget, which was supposed to help small businesses and simplify everything, seems to have complicated matters.
It's certainly a damp squib, I'm afraid. There's nothing exciting that people are going to get their teeth into. But we just have to mitigate that and give our customers and clients the best opportunities to benefit from it.
So thanks for the warm welcome. So now moving on. So for you, what are the key takeaways from the announcement? What do you think is most applicable to our clients and how are you advising them?
I think the first areas are around corporation tax. We can start talking about as a team. I think the other one is capital allowances and the pension limits, which kind of stick right out. And I'm sure we'll mention a few other bits and pieces.
Let's focus on tax.
So for corporation tax, the key line is 25% is the new rate from this year. So it's our clients have got to look at how they can minimise that cost that's coming in every year from then on. And capital allowances is the main line where they can benefit from that, fully expensing any assets that they invest in.
They are trying to simplify tax, but it's a bit of a shame that the threshold on the tax is only £50,000, and that level is a little bit low. It doesn't really help SMEs a lot, and then everyone's going to be thinking about how to stay under this 250,000 limit before the 25% kicks in. So the sliding scale, is just added a bit more complication that probably wasn't required.
Thrilling subject of R&D. I think it was announced in the budget that whilst there's higher relief for loss-making companies, there is other downsides to the R&D.
So following the budget, R&D tax credits continue to be in the firing line and very much capturing the attention of the government. There are some positives, I think, to be taken in that the offshoring arrangements have been delayed by 1 year. We see some consideration those that are following more capital-intensive businesses.
As we all know, R&D is a complicated subject, and at the CFO Centre, we've got experts that we work alongside who can always get the best from our clients.
With the R&D intensive, benefit, one has to spend 40%, of their total expenditure in order to actually qualify for this benefit. So it's quite an ask, and a lot of companies are going to struggle to do that if they're cash strapped in the first place in order to qualify for this smaller benefit.
It's also complex because they've got to be loss-making as well. Yes. So loss-making, heavily R&D intensive, for companies to survive being loss-making and R&D intensive, it's a very complicated, complex nature of a company. It is.
And positive news is you get about 27p to the pound if you do qualify.
Yeah.
So a bit of cheer on that one.
Part of the budget was labour and pensions and trying to get the workforce back to working. What do you all think about that?
It's a good point. So one of the biggest issues for individuals in the budget is our tax bands haven't changed. They're frozen. Therefore, more and more tax is going to be paid by individuals. Yeah. My gut feel is that employers and employees are going to work out how to help employees. So things like salary sacrifices will come more and more into the fore, be it sacrificing for pensions, for electric vehicles, for cycling to work, And that benefits a win-win with the employer and the employee, because the employer doesn't pay national insurance, the employee pays less tax and less insurance. So I think there's going to be, I foresee a bigger influx of initiatives for the employees and employers to work together for those type of initiatives.
Yeah, I totally agree. And there's going to be more flexibility on remuneration packages as well. Things like income protection for employees, things like the electric car scheme. We're going to see more demand, obviously people paying more into their pensions as well to benefit from both income tax and NIC savings. I think we're going to see a real drive to a change of remuneration packages, and it's going to happen pretty quick.
Yeah, if you do the numbers, if you've got 250 employees on basic salary of 40k, you think how much pension sacrifices can save on national insurance, and then electric vehicles are taking over. You can give sacrifices for that as well. So there's massive opportunity.
I think, you know, we've got to also look at some positives. I mean, they've frozen the personal allowance and also the higher income tax threshold. But sadly, for those earning a little bit more, the additional rate, which is 45%, that's come down from 150 grand to about 125 grand. 125,140 pounds to be precise. Yeah. So that means, you know, those guys in the middle to upper are going to be paying more tax.
Yeah, the one carrot that's been thrown out there in the future, though, is that the upper limit of pensions at 1.1 million is going to be opened up. So if you're fortunate to earn that 120 to 150,000 a year, you can start pushing more stuff into your pension funds. Although it's also flagged that if Labour come in, they'll change that. So Labour have already said they'll reverse any decision like that.
And it does impact on the people who wanted to retire early, put loads into their pension. Now all of the rules have changed. It does affect people.
So we're having a bit of a discussion on this pension lifetime allowance charge. You know, the Chancellor wants to remove it and abolish it completely from, I believe, 6th of April 2024. That's a massive one.
Yeah.
What do people think about that?
Yeah, well, Labour have announced already that if that comes in, they will reverse it if they win the election. So there's a window, frankly, there's a window of opportunity to invest in that pension fund before it gets stopped and cancelled from then on.
Yeah.
I don't think a Labour Party could reverse the effect, but they could stop it if they got in power.
Indeed.
So there's an opportunity to invest in pensions.
I mean, for me, the intended consequence was to empower the over 50s to come back to work, to get there and give them an incentive to continue to contribute towards their pensions. Yeah. I'm just not sure whether it has the desired effect, because we've been in this position so many times with political leapfrogging that it could change in the very, very near term.
But it's already changed. This very announcement has gone against all of the advice for older people to put into their pension. Do X, Y, Z, save for the future, and they've changed that around. So a lot of older people who are about to retire or have retired are thinking the rules have changed. And then in the future, there's an agreement between us here that if Labour come into government, it'll change again. So what do people do?
So I think you know, for it was designed to try and target, well, you know, doctors to come back in.
Yes.
Is it really? Is that the real reason? I'm a bit, you know, suspicious as to what the key reasons as to why this is. Looking out for the slightly better off. So hardly a common man's budget, I think.
Yes, I think that's right. I think it is focused towards the rich.
Yeah, if I was being selfish, the majority of my clients are hospitality based, the hotels, restaurants, wine businesses, food and beverage, and I don't see any real effort in the budget to help labour force coming back really, or the investment or to help with overheads and the cost of utilities in companies. So unfortunately for my clients, they're still working hard to get through the next year.
And I think that certainly the labour issues in hospitality aren't because of the older generations not working. It's something completely different. I think for my clients, which are primarily tech, the R&D changes have had a massive material effect on the businesses I work with, and what they can and can't claim for.
Thinking about sort of client-specific circumstances where we are at the moment and outside of the budget, what are you having conversations? Are there any common themes that you're having with your clients at the moment?
I think for my tech clients, we are concerned around the R&D payments with HMRC and their backlog.
Oh, yeah.
You know, during the pandemic, they were just writing checks. But now we're out of the pandemic and the rules are a lot more stringent. I do have one cash-strapped client who was reliant on the R&D payment. It's quite material. When are we going to get it? We don't know.
We've had issues as well in just getting, VAT reclaims back, and the level of questioning has suddenly increased, and as a result of that, the cash flows are being impacted. I mean, businesses shouldn't be relying on the VAT repayment for their cash flows, but sometimes that is the case. So that's having an impact on some of my clients.
I think the amount of challenges as well coming out at the moment, it just seems to be coming thick and fast, especially within the R&D team. I think there's been people seconded from elsewhere within HMRC to the R&D claim team, and there's a real pressure on any submitted claim at the moment to be challenged.
Yes.
And I mean, we're lucky with the CFO centre that we use reputable R&D providers, all ex-HMRC, that have the ability to go back on those claims. But I really feel for those that don't have the access to the specialist knowledge in order to be able to push those claims over the line.
Yes. And I think something that I think seems quite prevalent at the moment, throughout the CFO centre, I know myself and other CFOs have clients with surplus cash, but because of interest rates, the banking system at the moment's challenging. Where do we put that money? It's an asset and it's not really giving a return, so that's a real challenge at the moment.
Yeah, I've never known treasury risk to be so sexy and exciting. And over the last week, from SVB to Credit Suisse and possible other
Yes.
contagion throughout the industry, I think everyone's now looking at their bank accounts and saying we shouldn't just be one sole provider. What happens if one bank goes down and we're unable to operate, even if it's for 2 or 3 days? The repercussion that can have on a profitable business that's productive.
And just last week, I spoke to an expert on Treasury and how much cash you've got in the bank, in the banking system, and what levels are insured, etc. And you know, if you've got a spare million in the bank, are you supposed to spread it over 12 accounts to get under that 85 limit? And the advice was yes. To really, really spread it.
I've got a flip side to that I'm finding that the banks, the domestic banks in particular, are reticent to continue to borrow and to extend their borrowings. So I'm finding that they're just scared to commit further to businesses, certainly in my type of client industry.
What are you finding the debt and equity fundraising markets like at the moment? Are you doing any fundraising on behalf of your clients?
Well, we are. We're trying to raise some money for various developments in the UK. It's actually not that difficult to raise money in the UK. I think the basic business cases and plans have to be fairly robust, and I think the CFO Centre is well placed to really advise our clients to do that. But overseas, if we're doing projects overseas and I'm trying to get UK banks to lend overseas, very different story. Opening bank accounts for overseas companies trying to get into the UK, very different story. Being rejected on a number of occasions, and that's been quite tough to handle.
That's really interesting because I've got clients in Europe and England, and I've been told by many that the appetite for investment is just not there at the moment. And it's all down to the client, like you see the robust plans, the product. If there's a physical product, it hasn't got traction, etc. So there's a lot of different factors, but it's funny that I've got the opposite opinion.
It's back to the old rules of if you're asset backed,
Yes.
the banks are happy. But if you're not, if you're more relationship or transactional, then it is still going to be tough.
It's a good point, and I think we have that difference of opinion primarily because of the fact that I'm in the real estate business, and I think because it's asset backed, it's slightly different. But it's interesting to see how that space is also going to develop, in the short to medium term, given what's going on with some of the banks and people taking their money out and trying to find safe spots to put it in. So that's going to be interesting.
Yeah, I think it's sort of flavour of the month as well in terms of what sector you're operating in. Obviously, from my point of view, green sectors, a lot of carbon capture, carbon footprint is attracting a lot of interest at the moment, a lot of big tickets. Whereas conversely, you look in the lines of hospitality at the moment, and I really feel for them, they've really been dragged through the mud, both in terms of government policy and then also access to capital markets. But yes, I think the good news is normally these things can be quite flippant and they can change quite quickly, but it's just dependent upon appetite and approach. What do you have much foreign exchange exposure with your clients?
I've got foreign exposure, but I mean the foreign exposure. There's two ways of looking at it, right? It's in terms of where you know where your business is based, and in a way, you know, the pound being in such a disastrous scenario has benefited our business for our clients in that, you know, money is finding its way into the UK because things are cheaper, and so, you know, real estate, you know, ranging from 3 million to 25 million odd is at a discount of 20 to 30% in some cases on currency. So we're finding a lot more Chinese, Middle Eastern buyers coming in. The Russian market has been decimated, but interestingly enough, we're finding that the Middle East developments, they have no qualms in having Russians invest in Dubai and the Middle East. So all Russian money has gone into Dubai and the Middle East and is doing extremely well. Last year they had a record year. So it's a you know, very opposite cases happening pretty much at the same time on planet Earth.
I have some FX exposure, but I think that's one of the values we provide from the CFO Centre. We've got the right relationships and the right knowledge to hedge any risk.
And then on sort of expense management, I mean, it's fairly evident that we're living in inflationary times. I think this morning it was, what, 10.2% or something.
We just put on some scary music there. You know, so.
10.4 rise.
It's ridiculous. I mean, this is on the back of, you know, some of the highest cost of living issues
in
that we've
40
had.
years.
Yeah, and so if you take out the cost of living inflation, we're still seeing quite high levels of inflation, primarily driven by food and drink. And the fact is, you know, I was talking generally about this issue with some of my clients, and they said, well, there was a particularly hard sting on the energy bills going quite high, and now we're seeing that tail off a little bit. People are thinking, I've got a bit of cash, so then they're going spending on food and drink is the general kind of thinking.
So thank you all for joining us.
It's been an absolute pleasure. Thank you so much.